This is Chapter 14, Video 3. Let's launch. Greetings everybody and welcome back. This is going to be a really short video because there's not a whole lot of material going on here. I do want to talk a little bit about business usage of a home. So for example, we'll say for example that you have a person who's a Schedule C. And as a part of a Schedule C, they say, look, Kevin, I make good money, but I don't make enough money in order to do the things that I want to do if I go out and I rent office space. So what I did is I decided to take a portion of my house and convert it into my business use home. Okay, you can do this. Under a Schedule C, the way this is accomplished is that you're going to fill out a Form 8829. And then what will end up happening is you're going to take all the expenses of the home, utilities, mortgage interest, taxes, insurance, PMI, all sorts of different things, HOA fees, all that stuff. You're going to throw it into the expenses, and they're going to say, okay, you can take a portion of those expenses dependent upon the relativeness of the office size compared to the size of the home. So if I have an office that I'll say is 400 square feet, I have a 4,000 square foot home, 10% of every one of those things that I said I can take a deduction on. Okay. You do, in order to do it, you have to use, the taxpayer must use their home, part of their home exclusively and regularly. Exclusively and regularly are the key terms here, folks. And I've heard some doozies on this. I have personally experienced this. I had a client who didn't know when to shut up and said something he shouldn't have said. And they started digging. Then the IRS started saying, well, I don't think it really qualifies. Turned out it did, but the taxpayer just didn't know when to silence himself, and which taught me anytime you negotiate with the IRS, you go alone. You don't bring the client with you. So the thing is that it has to be used exclusively and regularly for business. Yeah. So one of the examples that I've heard with the IRS where they've kind of talked about this, where the taxpayer got into a little bit of trouble. They had the home office, they set it all up, but in the closet was all personal stuff. So the way the IRS argued it is, well, in order to get to the personal stuff, you got to go through there to get for a personal purpose. Therefore, we're going to deny the whole deduction. They were a little more aggressive on this, I think, in the past than they have been lately. I think, to be honest, the IRS is underfunded. But you could see that if you had an office examination, be prepared to defend this. This is one that they like to attack because it's one that's pretty easily defeated if it's not done correctly. Again, it's got to be that exclusively and regularly, either as a principal place of abode. It's a principal place of business for any taxpayer or trade or business, or a principal place to meet with clients, patients in the ordinary course of business. I remember when I was a kid, I used to watch this show called it was Donna Reed, the Donna Reed Show. She was, this is the 1950s, 1960s. She was married to a doctor. The doctor's office was in the basement of their house. This is, of course, the good old days when, in the 1950s, when they probably weren't as much about sanitation as much as we are today, especially with COVID. But that's something that I thought was just fascinating because, he ran his practice out of his house, and that's kind of how that worked out. So the home office expense deduction is only for self-employed taxpayers. Partially true. There is a way to do this if you have an S corp or a partnership. Basically what you have to do is you turn it into a self-rental. If you're in my live class, you've heard me talk about this, and that's kind of important. Again, if it's for self-employed taxpayers only, you can do the 8829. If you have a partnership or an S corp, there's a different way that you do this. Again, you do a self-rental, and it's actually not that difficult. You have a deductive for AGI, but deduction is limited to business income before the deduction. In other words, if you have income of only $3,000, you find out your home office expense is $6,000. You get the $3,000. Now, some of that stuff will carry forward. Depreciation will carry forward. I think rental. I think expense and taxes will actually not carry forward. They'll just put it on Schedule A. But basically, this gets you down to zero, and life is good. But again, there could be some limits to it. And then you have the actual expense method versus the simplified version. The IRS came out a few years ago, basically said, look, we don't want to deal with this anymore. So instead of dealing with it that way, you give again, exclusive for business, but $5 a square foot, up to $1,500. So we'll give you up $5 up to per square foot up to $1,500. If you take that, you can do that, and it can actually work out for you. Helps to actually do. There's actually a lot of benefits to doing that, and I can talk about that a little bit more in detail in class. Because there's some cost benefits to it and things of that nature. So home office, the actual expense method, you must allocate between personal and business use. There's direct versus indirect. So for example, if I pay for mortgage interest on my house, I'm going to have the indirect usage because it's the indirect, which is the portion that's allocated to my business office compared to everything as a whole. Now, for example, if I go out and I borrow $15,000 to make this office look good, and in order to make this office happen, that $15,000 worth of debt that might have the interest allocated to that $15,000 would be direct expense. Okay, so your tax probably never going to be direct, unless they have a tax on your business based on square footage, which is generally not the case anywhere. But you definitely want to make sure that you're following up on that. And then you have indirect expenses allocated based on square footage. That's kind of how they end up doing that, and it makes it work. Deduction, again, limited to gross income derived from a business. Use for a home on the Schedule C, net income minus business expenses unrelated to use of house. Deduct using same Tier 3 sequences for the homes. But businesses use instead of a rental use of home. The depreciation expense will reduce basis in home. This is one of the kickers. If you sell the house after you've had a business office in your home, the gain allocation portion to your depreciation will be taxed at 25%. And by the way, the gain exclusion is ignored for that portion of the calculation. So if I took, we'll say I took $1,500 worth of depreciation over the past 4 or 5 years when I've used the home, when I sell the house, even though my gain is $300,000, I'm going to have to pay gain equal to the amount of depreciation I took, which I think I said was $1,500. So I pay that at a maximum rate of 25%, as we talked about in Chapter 11. All right, the simplified method, again, 300 square feet times 5, up to 300 square feet times 5. It is limited to Schedule C income minus expenses. That is not changed. There is no depreciation expense. And this is one of the benefits of doing it this way. If you end up selling the house, say, for example, they do this and they live in the house for 20 years, you don't have to worry about any recapture tax as a result of this, and that's actually pretty good. Expense does not carry over, though. So if you have any expenses, absolutely no carryover. Okay, you can choose which one you want each year. So if you want to do simplified one year, actual in the next, and then simplified again, IRS doesn't stop you from doing that. All right. Well, guys, that's Chapter 14 wrapped up. Again, this is one of my favorite chapters. I've always really enjoyed it. I hope you enjoy it too. If you have any questions, feel free to reach out to me, and I look forward to seeing you in the next class.